What are you expecting from the Federal Reserve tomorrow? Not just the announcement, but maybe what we hear at the press conference.
Expecting a few things. One is a 25 basis point tightening. Two, to your point on the press conference, I'm expecting them to observe that inflation seems to be slowing, but still far away from their 2% target, setting themselves up for at least one, if not two more moves this year. I think they want to make sure that people understand they're still vigilant. They're not ready to pause and certainly not ready to pivot. But I think they would be wise to recognize that there has been some improvement. And the final point they'll make, I think, is there's been quite a bit of movement, quite a bit of tightening in the system, and they want to wait to see a bit how that works.
But you think it's possible we get, what, like a 0.5% tomorrow and then a 0.25% in, I think it's March? Or how would it look to you, Roger?
I think it's more likely to be 25 basis points tomorrow, which is a 0.25%, the same again in March, and possibly the same in May. And that's a slight step down because the tone that I've heard from the various policymakers that have spoken thus far seems to be one of recognizing quite a bit of tightening has already happened, and it's okay to slow it down just a bit. To take a read on how much impact they've had on the economy. And I think they'll have to recognize that some of the data coming in has shown that, in fact, inflation seems to be peaking, at least for goods, not yet services. And so I think they are capable of saying just 25 basis points this time, but more to come.
Why not? Yeah, see, I guess this is the question people have, Roger. It's like, okay, let's say they do 25 and 25, that equals 50, I think, 0.5%. Why not just do 50 now? Why kind of this? Why do you think done this, the pattern? If we could put the wall graphic back up where we show how they've kind of just done it in, over time. Why? Take us inside the intellectual mechanism for why they have to do it like that.
Okay, so the mechanism is as follows. First, every cycle is different. This time, as we know, they may have been a little wrong about the nature of inflation, so they started late. That forced them to move relatively quickly, and there are moments when they had to talk in a very hawkish tone. I think of the Jackson Hole speech. Now they've gotten to the place where interest rates are in what they think of as restrictive territory, which was their first goal: get to a restrictive territory as soon as possible, get ahead of this train of inflation. It feels as though they've done that. So at this stage, I think they stepped down a little bit because they want to be able to do two things. One is not surprise the market. So the market is built in, 25 basis points. They have not made any effort to correct that. So there's no reason to surprise the market. But at the same time, they want to be prepared to keep moving because they aren't really sure that the inflation genie is back in the bottle. And so that's why you get this gradual move, relatively gradual move. And by the way, let's put this into historical context. Normally, rate moves have been 25 basis points. Seeing these 50 basis points and higher moves is ahistoric, unusual. And so they're just returning to the normal historic pattern. So that is, I think, why you're seeing this highly unusual pattern now return to something more normal. But front-loading 50 at this stage, when the market is expecting more like 25, I think would be unwise.
And I want to talk about something else, Roger, if I can. It's a little off-topic, I guess. We talk a lot about inflation coming down, and I get it. We've seen the price of used cars come down a little bit. There have been some movements in the data. And I get that. And so politicians are going to kind of crow about that. But what I worry about is the inflationary effect of higher rates. Higher rates will bring down headline inflation, but they also increased borrowing costs, particularly for those who have to borrow money. I heard somebody describe higher interest rates as a wealth transfer tax from the poor to the rich, to those who borrow money from those who lend the money, the banks, if you will. So how much will higher rates have an impact on lower income people in the United States who don't have the credit or maybe the pricing power to combat some of these forces?
Well, you have to recognize that there are two kinds of challenges that the Fed faces. And one is the inflation challenge. And so inflation is widely regarded as an insidious and not very visible tax on every individual, including particularly poor individuals that you've just talked about. So if you take yourself back to the period of really higher inflation here recently, the main concern has been gasoline prices, the cost of commuting, rent has gone up quite dramatically, food prices have gone up. And so we shouldn't downplay the hidden tax of inflation on low and moderate income people. You're absolutely right that higher interest rates also fall on individuals who have to borrow. Yes, high interest rates and a steeper yield curve may make banks more profitable, but recognize that by getting inflation under control, the Fed is also trying to keep an economy going at what's called maximum sustainable growth, i.e. avoiding stop-start and avoiding a recession if necessary. And so there are benefits to society overall from having these higher interest rates if they drive out inflation and allow the economy to continue to grow at its maximum sustainable level. So that's a little bit of the trade-off that they're making here.